Let me now introduce Stuart Morgan, the Head of Investor Relations at International Airlines Group.
Thanks, Alex. Good afternoon, everybody. So if you just move on to a couple of slides. So at our Capital Markets Day last year, we set out our strategy, which we thought was the right one for the business. It's broadly the same as it was pre-COVID. And fundamentally, that's based on three pillars. So firstly, we want to continue to invest in our global leadership positions. We've got strong hubs in Dublin, London, Madrid, and Barcelona, and to build out the schedule and network that we think gives us a strong advantage. We wanted to continue to invest in our brands and our operations, and fundamentally make sure our customer propositions are increasingly strong. And then thirdly, we want to focus on our capital light, higher growth businesses. And the main one here is IAG Loyalty. When we deliver that, our medium-term targets are a 12 to 15% operating margin, 13% to 16% return on capital. We're going to grow earnings through 4 to 5% capacity growth every year. And fundamentally, we want to be underpinned with a strong balance sheet of net debt to EBITDA of less than 1.8 times. And we're very pleased this year to start turning that into shareholder returns in the form of EPS growth. We've announced an interim dividend in August this year, and then followed that with a share buyback at Q3 results last year. So fundamentally, IAG is a group of world-class airlines delivering world-class margins and returns, and we think attractive shareholder returns. Moving on to the next slide, this is just a summary of our Q3 results, where we're pleased to grow revenue, profit, and margins. We increased our revenue by just under 8%, operating profit by 15% to just over 2 billion, which is a record for the group. And we are seeing a sort of really good performance across the group. And then in terms of our sort of margin targets, where we're sort of making good progress in increasing our margin, increased it in Q3 by 1.4 points to 21.6%. So again, I think apart from perhaps Ryanair, that makes us the most profitable airline business in the world. I think it's important to say that demand remains strong in all of our markets, and particularly our core markets. Actually, particularly our core markets. I'll come on to the odd exception here or there. And we saw a good increase in passenger unit revenue in the third quarter. And we continue to focus on improving our customer propositions and operational resilience. We've made good progress, particularly at BA, but I think most of you will recognize that there is more to go there. In terms of the profitability, that's turning into significant free cash flow generation, which we've spoken to a lot over the last couple of years. We're investing in the business, and at the same time, we are making sure our balance sheet is increasingly strong. We announced a 350 million share buyback. We think that sort of at an average rate of buying in the market, that will take us up to results in February next year, at which point we hope to update the market further on our capital allocation policy. And then finally, just in the fourth quarter, we expect our strong financial performance to continue for the rest of the year. So just in a bit more detail, in terms of the third quarter profit, it was delivered particularly by very strong passenger revenue. We saw some quite nice cargo revenue increasing, as well as our loyalty revenue, which continues to grow alongside the business. That was offset with some increases in fuel costs, but obviously less than the benefit of revenue. So that's the 2 billion we just talked about. And from an operating company basis, an airline basis, British Airways has produced the biggest improvement year on year. And probably worth noting here that Aer Lingus had an impact from industrial action in June and July. So that's what you can see in that particular reduction there, as well as a little bit of what I'd call healthy competition going into Dublin through the summer. but overall a very strong performance. Moving on to the next slide, here we just sort of highlight some of our financial and operational KPIs. So we increased capacity by just under 6%. That was a little bit less than we planned to, and a lot of that was due to British Airways having issues with its 787 fleet and to a lesser degree the A380 fleet, and that's going to have a knock-on impact, the 787s, into the fourth quarter and the rest of the year, and that's because of the Rolls-Royce engines that are on those planes. Unit revenue, as I said, was up 1.2%, which was a very pleasing performance. Non-fuel cost also up a little bit, slightly higher than we'd have liked, broadly in line with what we've guided to for the rest of the year. A lot of that has been driven by disruption plus some costs in our non-airline businesses. And as I said, profit's been very pleasing. Operating margin at 21.6%, again, kind of a standout performer. A net debt to EBITDA at this point in the year of sort of 1x. You'd expect that to unwind a little bit as we go into the end of the year, just because of the seasonal working capital flows. So that'll end up a little bit higher at full year. Moving on to the next slide. Just by airline, as I mentioned, Aer Lingus not quite as good as last year, but still with a very healthy margin in that third quarter of just under 19%. As I spoke to earlier, British Airways, a £250 million improvement year on year. Iberia continues to be a nice, strong business. It's growing significantly. So with 12% capacity growth in the quarter, a small unit revenue decrease is a pleasing outcome. And then finally, from an airline perspective, Vueling at 27% is an exceptional performance. Vueling operates particularly in the sort of what I call the EasyJet space. So strong out of Barcelona and in some of Europe's bigger airports such as Gatwick and Orly. And then finally, as I alluded to earlier, also loyalty continues to be a very good business that is not as seasonal as everything else. It delivers good margins and good cash flow throughout the year. Moving on to the next slide. In terms of our core markets, if I sort of start with the North Atlantic, our capacity grew at just under 4%, and our PRASK, our unit revenue, increased by 3.5%. And I think this is indicative of a particularly strong market. It's constrained in terms of the competition. What we've seen is British Airways in particular has had a very strong quarter, and frankly, a very strong year, as some of the US competitors have reallocated capacity away from London to some degree into direct routes into Southern Europe. Latin America, as I sort of just said just now, we're seeing strong growth into Latin America. We see that as an attractive market going forwards. There's a strategic opportunity for Iberia to reinforce its position there. Some of the carriers down in Latin America have all just been through Chapter 11. So we are investing in our market position at the same time as seeing the sort of the LATAM to Madrid market improve. 5-10 years ago, it used to be a sort of a low quality market in terms of sort of economic migrants. What we're seeing now is a lot of investment going into Spain, a lot of wealth going into Spain from Latin America. And this is an opportunity, we think, to drive lots of future growth. And then finally, Europe, we've seen very strong demand in Europe across the year, but in particular in the third quarter. I think with the exception of, let's say, one other airline, everybody fundamentally is seeing really strong demand in Europe, and this is just good short-haul demand for travel. And again, with 5% capacity growth, we delivered positive unit revenue. I think the one area of the world that's not really working very well at the moment is Asia Pacific. We've grown quite a lot, but that's mostly just reinstating pre-COVID routes, more capacity into places like sort of Singapore, Bangkok, Hong Kong, and Shanghai. We have tweaked the schedule as a result of the weak demand in China. So British Airways has cancelled its Beijing route for the rest of this year, and we'll continue to reevaluate that. And that's partly as a consequence of both the weak demand, but also the lack of availability of aircraft to fly those routes. The other fundamental challenge here is that to get to China in particular, you have to fly all the way around Russia these days, which increase time and therefore the number of aircraft you need, but also costs to deliver that. So both crew costs and fuel costs are significantly increased, whereas the local Chinese carriers can fly across Russia and therefore have a fairly significant advantage here. So there's a little area of weakness, but otherwise, fundamentally, we're seeing really strong demand for travel everywhere else in our network. Going on to the next slide, just quick little sort of profit after tax here. Just a couple of things to note at the half-year results. We talked about an exceptional tax credit due to a tax ruling in Spain, which we think there's a reasonable chance that will unwind. And then the 50 million break fee for the Air Europa deal, which, if I'll just quickly remind you here, we thought this was a highly attractive deal strategically, so we could build out the Madrid hub. The EU were acquiring remedies that ultimately would not make that in the best interest of shareholders, so we withdrew from that deal and announced that at the time of our results in August. Moving on to the next slide. Fundamentally, this is a business that now has a strong balance sheet. Net debt at the end of the third quarter of 6.2 billion, just under, and one times gearing. That includes the payment of the interim dividend of 147 million. CapEx for the year, we think, is going to come down a little bit. We were talking about 3.3 billion at the half-year results. That's partly as a result of the phasing of investments, and in particular IT investments. But we're also starting to see the delivery of aircraft slip due to the fairly well-known problems that both Boeing and Airbus, and then obviously both Rolls-Royce and GE and Pratt & Whitney are having. So if you look to what we said at the half year for CapEx going forwards of sort of 4 billion for 2025 and 2026, that will ultimately likely be a little bit less in both years as well. Having said that, we still expect 20 aircraft this year to be delivered, 4 in the fourth quarter. Most of these have been sort of a short haul. What's quite exciting is 3 of those 4 in the fourth quarter are the new A321 extra long range XLRs, which are going to go to Iberia and Aer Lingus. And the strategic opportunity here is to use our hubs on the western edge of Europe to fly transatlantic in a more efficient way. And this gives us the ability to do it through the seasons. So Iberia is going to be flying Boston and Washington through the winter, which it wouldn't ordinarily do. And then add frequencies. So both Iberia and Aer Lingus will be able to add frequencies and target secondary cities. So Aer Lingus has talked to Nashville and Indianapolis as being markets they can now target directly, which you probably wouldn't be able to do with a wide body aircraft. So we're quite excited about the opportunity to do that with the XLRs. And then, as I mentioned earlier, leverage is expected to increase a little bit by the end of the year. Going on to the next slide, we just set out our capital allocation framework. So we set this out again back in the CMD last year, and we're very pleased to have made some progress across all of this. So the first priority of the business to make sure we have a strong and sustainable balance sheet. We use less than 1.8 times as a proxy for investment grade, which gives us access to attractive rates of financing. And as I say, that was at about 1.0 times. We then want to invest in the business. So that's both fleet, but also all of the other things we think you need to invest in to remain competitive and to keep your revenue opportunity up. So that's lounges, that's digital, it's apps, it's websites, it's commercial platforms, and I'll come on to those in a little bit. In terms of dividends, we were pleased to announce the interim at half-year results. And if you look at sort of expectations for the full year, you'll sort of see that that's probably a sort of a 1/3, 2/3 split to what you might expect on a full year basis. And I think the analysts here are using a sort of a 15% payout as a proxy for what they might expect on a full year. And then finally, having sort of established a strong balance sheet and invested in the business, we are committed to shareholder returns. We announced a buyback. We think a buyback is the best use of cash for us at the moment, given the current valuation of the business. And as I said, we'll come back to what we can do further going forwards. But given the amount of cash we expect to be delivering in the next few years, we think there are big opportunities to do more there. So just quickly coming on to the sort of the strategy. Again, at the half year, we talked to sort of driving margins. And one of the things we expect to do, so last year, our full year margin was just under 12%. We expect to increase that a little bit in the next couple of years. The three main levers of doing that are through British Airways. So BA made a 10% margin last year. Historically, they were making 15% in 2018, 2019. And we've got the objective of getting back there. Leveraging our Spanish platforms, and Iberia in particular has structurally shifted to becoming a more profitable business. And we want to continue to grow the group profit at those high rates of return. And then finally, loyalty, growing 10 to 15% a year, high margins, high cash generation, less seasonal. So three fairly significant value drivers there to deliver the medium-term targets that I spoke to at the beginning. Coming on to the next slide, just to remind you of our key markets. So the North Atlantic, IAG in its various constituent parts is the biggest operator of transatlantic capacity, particularly from London. And alongside American Airlines, we have 58% share of that London to the US market. Latin America, as I just said, is a increasingly attractive place for us to be. The phrase everybody seems to use is Madrid is the new Miami. And you are seeing, as I said, investment and migration to Spain, and that's delivering, that delivers your more resilient, more robust, long-term demand for travel, which is attractive. And then finally, intra-Europe, as I said, kind of our focus is mainly in domestic Spain. We are very strong in domestic Spain. But we also see some of our other key intra-European flows as being very strong. Quickly on to the next couple of slides. So slide 15 just speaks a little bit to the focus on punctuality. Punctuality is a combination of both something that is important for our customers, and therefore we are very focused on delivering an improvement there, but also for our efficiency. So a punctual airline is an efficient airline. It drives productivity in everything we do, and it reduces costs across the business, both direct costs. So the cost of disruption is quite high, but as I say, also indirect costs in terms of efficiency benefits. And I think BA is improving significantly, and Iberia and Vueling are two of the most punctual airlines in the world. And that's despite a lot of the air traffic control issues that we've seen, not only this year, but in the last 20 years. And if there's a fundamental challenge to efficiency in Europe, it's air traffic control and the ability to manage our way through that. Coming on to the next slide. As I mentioned, we're investing in our customer experience. So Aer Lingus is focusing on what makes Aer Lingus unique, and in particular the TSA pre-check in Dublin is now being mirrored on the other side of the Atlantic, coming back the other way. BA is investing in its lounges and its club suites. So 69% of Heathrow long-haul aircraft currently have club suite installed. Club suite drives significantly higher customer NPS than the old product. The old product was groundbreaking in its time, but we clearly need to invest as quickly as we can in replacing it. And the only constraint here is that the supply chain in its turn has its issues. So, for example, one of the main areas of installing it is in Tel Aviv. So obviously we've had to shift embodiment away from Tel Aviv. In terms of Iberia, again, investing in the customer proposition at the airport through Fast Track, refurbishing its fleet, adding the L bins on its 320s, which are the ones where you can put the bags in sideways, which drive huge positive customer satisfaction. And then finally, Vueling. Vueling as a low-cost carrier is particularly focused on digital and digital self-service, digital booking management, digital disruption management are all key things that they want to do at Vueling. Moving on to the next slide. IAG Loyalty. I mean, the philosophy with loyalty is earn and burn. So what we want to do is to create the incentives for people to earn Avios, and that's both on our airlines, but also through our non-airline partners. And American Express is the biggest example here. And then to further incentivize the desire to earn Avios, we want to create more opportunities to burn Avios. So the Avios-only flights are going fantastically well. We introduced Wine Flyer last year as an opportunity to spend your Avios in a different way. And then we're pretty excited that we're now introducing BA Holidays into the loyalty ecosystem. As a part of BA, it was a sort of slightly unloved business, but actually pretty successful nevertheless. We think by putting it into loyalty, we can invest in the people. They've got a new CEO there who's come from TUI, which we think is an exciting development, and also investing in the platform. So as I said, kind of it hasn't been invested in, and we think it's a huge opportunity in the same way that EasyJet, Jet2 talk about the opportunity for holidays. And again, if you put this side by side with the premium leisure traffic we carry with the destinations we serve, we think it could be quite attractive going forwards. Into the next slide. Just in terms of sustainability, being a sustainable airline is obviously something that is a matter of focus for us. The key things to deliver now are the mandates for SAF use by 2030. So in the UK, though, we need to be using 6% of our fuel needs to be SAF. On a European basis, it needs to be 10%. We're a leading airline from this perspective, but our focus mostly remains on securing supply of SAF. And most of the supply currently is starting up in the US. And what we're trying to encourage in Europe is the development of more production in Europe. So it's about making sure that we have access to both volumes and volumes at the right price. SAF in itself is probably about 3 times the price of jet fuel at the moment. So, as I say, some of the commercial agreements we're putting in place, we think give us a competitive advantage going into the future. And then in terms of our outlook, as I said at the beginning, fundamentally, we want to continue to grow, but are being stymied to some extent by the availability of engines and therefore aircraft. Our cost expectations are in line with what we've expected throughout the year. The price of fuel has been a little bit volatile, but generally has come down quite significantly through the year. So we think there's a little bit of a saving in our total fuel bill this year. Leverage, again, as I've mentioned several times, is going to go up a little bit. And therefore, you put all that together and we expect a strong financial performance going through to the rest of the year. And frankly, going forward beyond that. So coming finally onto slide number 20, we expect positive long-term sustainable demand for travel. One of the really key things has been post-COVID, travel has rebounded super quickly. It's been very resilient. And we think that is a long-term trend. We're executing our transformation program to deliver the margins and returns that we're targeting. Transformation means doing everything better. So it's not just a cost thing, it's a revenue thing, it's a customer thing. It just means that we just look at everything and try and do it better. And we're on the journey, so to speak, but we think there's a long way to go. Disciplined capital allocation is a key part of our investment case, we think. Given the success and strength of our business, we're generating a lot of free cash flow. The balance sheet is in a really good place. We're investing as much as we can in the business, but we're constrained to a significant degree by our ability to go and refurbish planes, to buy planes, to implement more digital. So with a fully invested business and a strong balance sheet, that brings us to being committed to sustainable shareholder value creation and cash returns. So an interim divvy, a buyback, and as I said earlier, I think you'd expect us to continue with more of the same in the next few years. And on that basis, at that point, I will open the floor to questions, Alex.
Brilliant, Stuart. Thank you very much for that. What a strong performance in Q3 and in fact throughout the year. And looking back at the share price performance over the last 12 months from the last webinar you did with us in December 23, the shares are up almost 70%. So investors who followed you and been on board for the year have done very well. As you said, we're now going to take questions. And if you do want to ask a question, please type it into the Q&A box at the bottom of your screen, and we'll try and cover as many questions as we can in the time. So look, just starting on the first one on the dividends. Last year you said you'd restart dividend payments once the balance sheet was secure. You've done that with the dividend payment in September. Consensus has the full year dividend of 7.9p and cover from earnings of 6.7 times. What is the company policy on dividend cover?
So we're going to update the market at our full year results in terms of a formal capital allocation review. I think what we're really committed to is having a sustainable dividend. So given that this is a cyclical business, if there's a downturn, when there's a downturn, we'd want to make sure that we could at least maintain the level of dividend. So I think, as I mentioned, I think the analysts are looking at something that's probably a 15% payout ratio. Given our current share price, that sort of makes a 3% yield. And then we'd look in terms of further shareholder returns at probably either buybacks, depending on where we see valuation, or special dividends, which we've historically done as well in the past. So I'd say the framework is, let's make sure everybody gets a sustainable dividend. You're guaranteed a return every year. And then any excess cash gets returned to investors in a way that we think is most rewarding for shareholders.
Thank you. I think the next question which has come in as sort of linked to that, maybe it's just worth clarifying at this point here, which is, how should we think about the mix of distribution across buybacks and dividends? I think you touched on it before, but maybe just to clarify here.
Yeah, so as I say, I would sort of say the fundamental starting point is a dividend, probably at about the level of payout that we currently have on a full year basis. And just a quick little technicality here. We announced the interim at half year this year just because we wanted to get confidence back into the investment case. We normally do that at Q3 results, so we'll probably revert to doing that at Q3 results. But as I say, that's your fundamental underpin. And then anything over and above that we think is excess cash, and sort of failing anything else to invest in, we will return to shareholders. So given that we expect margin accretion and therefore significant cash flow generation, I think our returns to shareholders in the next few years should be pretty attractive.
Brilliant, thank you. Question here on fuel. What are your expectations for fuel price changes in 2025, and how does $1 a barrel move in the oil price impact profits?
So our approach to fuel is that we tend to sort of hedge on a rolling 12 to 18 month basis. So we tend to be, at the moment, we're probably 65% hedged for the next 12 months, and that drops to about 40% for the following 6 months. I think at the moment, if you look at the price of where we're hedged at, and we use collars and caps to do that, so it's a bit of a sort of a floating target, but effectively we're going to see sort of perhaps a 5 to 10%, probably more like a 5% reduction in our fuel cost next year, our unit fuel cost. And it rather depends a little bit on what the dollar does as to the absolute amount that we end up with. But if I put all of that together, fuel will be a fairly decent tailwind next year. The thing that you'd feel more comfortable about in terms of where does that end up in profit, historically that's ended up with more capacity coming into the market, inefficient capacity, and therefore your ability to drive revenue is diluted. Whether we like it or not, people cannot put sort of irrational capacity into the market now because they don't have access to the aircraft. So as I say, I think we'd expect a fairly significant amount of that to stay in the business, so to speak.
Thank you. Moving on to another topic here. What appetite does IAG have for further acquisitions?
We were set up as a vehicle for consolidation, and I think we've done a pretty good job of that in the past. And as I said, if you look at the margins that our businesses are making now compared to what they made when we bought them, some of them, I think that's one of the value drivers in IAG as a corporate entity. As I said earlier, Air Europa we thought was a really attractive opportunity to grow the Madrid hub. So Iberia in itself is actually a relatively small kind of hub airline if you compare it to the likes of Lufthansa or Air France or KLM in other European cities. And we just sort of thought combining the two would make for a more attractive network into Latin America in particular, and also a little bit into Brazil. And I'll come back to that in a bit. The European Union decided that buying a number two in your own hub was probably a step too far, essentially, for them. So we've had to withdraw, unfortunately. We're going to have a look at TAP, which is the Portuguese airline. Again, strategically, if you have a look at where we're strong, it's being sort of on the western edge of Europe and it's flying transatlantic. And TAP has a particularly strong network into Brazil, which is the one part of Latin America that we don't really cover. I think the challenge we're going to have with TAP is the degree to which the Portuguese government wants to remain involved. They put a lot of money into it during COVID. They'll want to recoup as much of that as they possibly can. If you look at the putative valuations that some of the other potential bidders have put in, I don't think they're going to get that value. And therefore, we think the Portuguese government will want to retain a stake, minority or majority, which is not really how we like to do things. So that's something we're going to look at. If you look at other opportunities in Europe, there's nothing really that fits our strategy. So where we're looking to kind of grow here is sort of alongside the loyalty business. Our capital light growth includes working with our partners to deliver that growth without having to buy the planes. And Qatar here is the biggest example where BA, Iberia both fly into Doha, and then Qatar will fly you more or less anywhere in Africa or Asia that you want to go. So that's a mutually beneficial arrangement. American Airlines in North America, Japan Airlines into Japan, Latin American or LATAM rather into Peru and Ecuador. So all of those are ways that we can grow without having to actually buy anything. So as I say, fundamentally, there isn't an awful lot around. We'll have a look at opportunities, but it also means that having grown organically, that is a reason why we think returns to shareholders will be attractive going forwards.
Okay, thank you. A bit of a technical question here. What's happening to the HMRC Avios VAT investigation, and when is this likely to conclude?
Yeah, so this is a case where HMRC, how can I put this? HMRC have a difference of opinion over treatment of tax, historical tax assessments at loyalty. The way it goes is they get to decide that they don't agree with us and we're going to have to hand over the cash whilst we appeal. I think we sort of said in our last set of results, we expect the assessment to be about £600 million, which we have available to us. That's not part of our, that doesn't diminish our returns to shareholders. And that's a process that's going on. So it's currently in HMRC's court. And as and when they want to complete that process, we'll then appeal against it. And we think we've got a pretty good case in that situation. So it's a bit of a distraction, but as I say, kind of we are confident that we will see a good outcome in that.
Okay, thank you. And the last question here is the Trump presidency like to have an impact on your operations at all?
Look, I mean, if the US customer continues to benefit from a strong economy, BA's got sort of 35% US point of sale, Aer Lingus has got about a 60% US point of sale. That will be good for those airlines. I think the flip side is a stronger dollar makes fuel a bit more expensive. And I think the sort of the area that we're sort of waiting to hear more on is tariffs. So Boeing versus Airbus may end up in some sort of tariff war between the two. We've got a reasonably secure supply in the short term, but whether that affects the long term remains to be seen. So as I say, at the moment, on balance, we think it's a positive thing.
Stuart, thank you very much. We have no further questions. Thank you for today's presentation and bringing us up to speed with the Q3 performance and the strong, I guess, optimistic outlook you have for the rest of this year and into 2025. To all the audience, thank you for coming in today. Please, as you leave, could you answer the feedback as you go through that? I know management really appreciate your responses there. And as I say, thank you very much for attending, and we hope to see you all soon.